Hey, good morning, everyone. Marty Missouri here, June 14th, 2025, with your end of week update. I am actually going to keep it relatively quick this morning, despite all the happenings on the global scene. I don't think there's anything that I can add to the Israeli-Iran situation that you don't already know from the main headline news. It is a very hot situation, so to speak, as I speak to you. So we'll watch it develop and unfold over the next few days, and we'll be here to assess how the market reacts to it and its implications on the economy. So what is interesting, though, and we're talking about, is really the movement or the intermarket relationships that have been developing of late. They are atypical. Not what you would normally expect, particularly with regard to how the dollar and yields are reacting to certain information and events and so on. So I want to talk about that. In fact, let me just jump into that before we get to the charts. So the dollar, for example, at a time when typically the dollar would rally big time. For example, the international events of the last day or three. Typically what you would expect when you have a crisis, the dollar would tend to rally pretty significantly as folks would run to the safe haven of the dollar, particularly the safe haven of U.S. Treasuries. And this is our dollar chart. You can see we're still in that downtrend. We did get a little bit of a rally here yesterday, but it closed off of its high. In terms of yields, we actually got the opposite. We didn't get a bunch of buying of treasuries. We actually got more selling of treasuries and an increase in the treasury yield. So, of course, those who believe that the dollar's world reserve currency status, the attractiveness of treasury debt relative to the size of the U.S. deficit and so forth are, shouting from the rooftops that finally things are changing, that the appetite for U.S. Treasuries is waning internationally, and even at a time when you tend to see massive buying of Treasuries, we didn't see it yesterday. I can sympathize with that, and I think we need to pay very close attention to the long-term prospects for the dollar and for Treasuries in this world that we live in today, particularly when we see this multipolarity, if you will. We see the U.S. inspiring countries to go their own way, take care of their own military defense spending and so forth. And, of course, trade wars don't inspire a lot of friendliness between countries. Nevertheless, the dollar is the world reserve currency. That's not about to change. And the Treasury is still the safest, certainly fixed income vehicle out there. Now, gold did what you'd expect. Gold had a very strong day yesterday, so clearly there was buying of gold as the haven trade, if you will. And I should tell you that the actual weekly auctions of U.S. Treasuries have not been all that bad. So it's not like people are not lining up and showing up both domestically and internationally to buy our debt as it's issued to fund this seemingly ever-growing budget deficit. It's just that yesterday, bonds surprisingly sold off. Now, could be that it's fear that the spike in oil prices will filter through to inflation and therefore inspire higher rates going forward, and folks were selling bonds because of that. So right now, it's too soon to say that it's a trend in the making. As the old saying goes, one day does not a trend make, although we are seeing trends developing under the surface that don't necessarily jibe with what you would expect. But then again, it's all about the folks you listen to. Some people are in the recession camp, and that we will see bonds react to that with rallies to the upside in price, treasuries I'm speaking of, and a decline in the yield. That would not surprise me, but then again, you look at the size of the deficit spending that's happening before we get into recession, meaning it's rising. Typically, you want to hold that powder or keep it dry until we are needing it in a recession. So if we do have a recession, that's going to exacerbate the fiscal engine, if you will, and they'll And obviously with revenues dropping and increased government spending to offset the impact of falling aggregate demand, as they say, that would be falling consumer activity, all that requiring more debt issuance, you could make a case that yields are not going to have that traditional decline to very, very low levels. We'll see. I still think that we are going to see yields decline well below the 4.3% on the 10-year if indeed we do see recession. But that's not what everybody believes, and I'm of course open to all possibilities. And I will say again, these dynamics are interesting, and it does give some weight to the argument that the rest of the world is engaging in a somewhat of a dumping or a selling of U.S. assets. And by the way, folks, those of you who've been with us for a while on these videos and clients know that we have been anticipating that when it comes to the equity markets, and that is indeed what we've been seeing, and that is the dollar being sold, i.e. U.S. equities being sold in favor of equities that provide better values in other parts of the world. And as I keep saying, that's helped our relative performance immensely so far this year. Okay, so let's just leave that there. I will be talking oodles, no doubt, and writing about these present dynamics in the dollar and intermarket relationships as things unfold in the months to come. Okay, so let's just look at the charts. Remember last time I said we are firmly in this rising wedge pattern, which is a bearish pattern. Bearish divergences, we won't get a sell signal unless it breaks below the uptrend line. And of course, that happened. Tried a little bit of a retest at 60.27 on the S&P. Failed there, so we shall see. We know why this happened, of course. There definitely was a catalyst, but technically, this looks like something that should see further downside in the days to come. No guarantee that would happen if somehow there was some swift resolution or ceasefire or something related to the conflict of the day. Well, then, of course, I could see stocks reverse that very, very quickly, and we'd be having a little bit of a different short-term conversation. We'll just look at the daily charts. I showed you last time how ugly the longer-term charts currently look. The NASDAQ 100 index, same thing. Big thrust below, close below this 528. This is the QQQ, the ETF that tracks the NASDAQ 100. Very solid bearish divergences coming off of overbought levels. Again, technically, you'd expect more downside going forward for a while. The dollar, as I already showed you, continues very definitely in this downtrend. I actually thought we'd see it pop out of here. I might have suggested that if I knew the news of the day that was coming, and certainly we're not getting much love for the dollar, as I already hinted. As for treasuries, again, I showed you this as well, sitting right here in this trading range between 4.5 and 4.3. We'll see which way it ultimately will break. It won't sit there. If we got strength in the economy and so on, you'd see it break out to the upside. And again, traditional thinking would suggest that it's going to break out to the low side if the economy weakens from here. Gold had a good day. Probably should redraw my line right here. You got enough points working together. So we're kind of in this channel, somewhat of a wedge, if you will, very much in this yellow box right here, this trading range. Of course, with that news, gold is pushing. In fact, I need to fix this. It's right up here is where it is, right at the top of that resistance, and just right on these record highs that we've seen right here. These are major bearish divergences right here, folks. We do have a buy signal right here, but the trend is still bearish. So I think that when the dust settles, hopefully soon on the Middle East crisis, probably we'll see gold give some back. As I keep reporting, we are cautious gold in the short run, bullish gold in the long run. Lastly, I pulled up our chart that shows the Fed funds rate in red, the 10-year Treasury yield here, and the average 30-year mortgage rate in blue. And, a few weeks ago, the president was pushing the Fed to lower interest rates by 1 full percentage point. And I think that's out of fear of the economy and the fear of the drag from tariffs that they'd like to do and so forth. But I was saying at that time that that would be a mistake, that you'd actually get the opposite impact. That if you cut rates right here before the economy, at least the hard data is really showing signs of weakness, you're probably going to see yields go up on you, which is not what they're looking for. Might even see strength in the dollar in that scenario as well. And they're not looking for that either, by the way. So I wanted to just illustrate, and I know I've been saying this, that back here in September of last year, we saw a 50 basis point, a 0.5% cut to the Fed funds rate. And look what we got. We got an immediate spike in mortgage rates from below 6.5 all the way up to 7.3, eventually to peak at almost 7.5, 7.41, as they cut interest rates a couple times, right? 3 times. And the 10-year immediately responded with a move higher. And of course, the mortgage rates are going to reflect the move in 10-year yields, as you can see right here. We're still at, historically, at least recent history, elevated rates, and we're not, technically in recession just yet. We are seeing some weakening in the data, particularly the soft data, although the latest consumer surveys showed some hope. They actually were up relative to the month earlier, and that was largely because of the view that tariffs are not going to be as debilitating for the economy, that they're going to be lower than what was originally threatened. Although their longer-term inflation expectations are still elevated, and that's going to be interesting. It's going to be interesting when the Fed meets next week. It wouldn't surprise me to hear them talk about rate cuts going forward. The futures market is discounting 2 rate cuts later this year, which says the market is anticipating a weakening of the economy in the second half of the year. And we're in that camp. Our PWA index is a negative 16. It's no change week over week. We had an improvement in small business sentiment that moved the needle up a little bit. But then the cost of shipping really spiked, and it wasn't because of strength in the economy, as you might imagine. And so that was a negative. So they offset one another. Everything else stayed the same for us in terms of our scoring. So we're sitting right now with a negative 16. Only 9% of our 43 indicators are positive, 26% are negative, and 65% are neutral. So we think that there is elevated recession risk still in this economy. So folks, I'm going to leave it there. There's going to be lots to come, of course, in the days and weeks that follow. Hope you have a great rest of the weekend, and I'll talk to you next week. Bye-bye.